So see if we get everybody up. See, now Rex, is there a view for me to see everybody?
You won't be able to see anybody.
Got it. Okay. All right. Well, good afternoon, good morning, depending upon where you're coming from. My name is Joe Santora. I'm with Irontrax, and we canceled the asset valuation summit this year, but our guest today was gracious enough to allow us to still glean some of his information. So Mekael Teshome is going to come in today and talk about the economy. For those of you that don't know Mekael, he has spoke at the ASA events, the American Society of Appraisers. He has spoke to the Equipment Lease and Finance Association for the people that run in my world. I'm sure he has spoken a number of other, probably more prestigious places. I'm just unfamiliar with them because this is about as high rent of a group as I run with. But Mekael comes to us as the VP and Senior Regional Officer at the Federal Reserve Bank of Cleveland. And he started, Mekael started his undergrad at Taylor University, where he studied international sales and political science. He received his master's at Vanderbilt in economics. And then after that, he went to Moody's Analytics, where he spent about 3 years, moving on to become an economist at PNC, where he spent a little over 6 years. In the last almost 3 years, he's been with the Federal Reserve of Cleveland. So Mekael, without any further ado, thank you so much. And I will, oh, one last thing before I turn it over to you. Questions, if you have questions, by all means, Mekael wanted them coming in as you had them, and we'll do our best to manage those as they come in. Mekael, thank you so much.
Oh, thank you, Joe, for having me. It's a pleasure to join the group again virtually. I miss everyone, but hopefully we'll be able to see each other soon. And as Joe mentioned, I'm with the Federal Reserve Bank of Cleveland. I have to be careful and give you the usual disclaimer. The views I present are my own only, and they are not official positions of the Federal Reserve Bank of Cleveland or the Board of Governors of the Federal Reserve System. So please be aware of that and take these as my own insights. So today we're going to talk about economic conditions. We'll keep it high level. We'll keep it conversational. Feel free to pass questions on to Joe. Joe will stop me at convenient points. He can throw the questions out and we'll be able to discuss those as we go along. So keep those questions coming. For our session today, I'm going to break it up into 3 broad buckets. I'll start by taking a look at what we're seeing in terms of output or GDP. We'll look at how the pandemic has affected different sectors of the economy. Then we'll get into some of the labor market indicators. We'll focus on the job market there. And then we'll finish with a brief discussion on inflation trends and monetary policy. On overall activity, so we'll start with output. We do have second quarter GDP figures. As no surprise, second quarter, we saw a very steep drop in activity. On the chart on the right-hand side, you see the level of real GDP. And then on the left-hand side, you see the growth rate of real GDP. And, with such large changes, it's important to see both the levels and the growth rate. So you'll see that I'll have side-by-side charts throughout the presentation here. But what we saw in the second quarter, a large drop in activity, 31% contraction in real GDP in annualized terms. And that puts GDP back to where it was around 2014. Now, since then, since the second quarter, as various parts of the economy started to reopen, a number of indicators have rebounded, which suggests that the second quarter really was the bottom for the contraction. We don't have Q3 numbers yet, but those are likely to be very positive. Sticking with the overall path for the economy, forecasters are expecting fairly sizable increases in output when we get into the third quarter and fourth quarters. So I have here forecasts from the blue chip economic indicators. And what you see on the left-hand side are forecasts for 2020 growth and 2021 growth, just the total year growth. And you can see the evolution of the forecast from March through October. And in that table on the right, you'll see the forecast for the third quarter and the fourth quarter. And the consensus forecast, we call that the median, but you also have there the average of the most optimistic forecast, the top 10, and the average of the most pessimistic forecast there. And there are a few themes to pick out here. So the first thing to keep in mind is that as we look at the third quarter outlook and the fourth quarter outlook, in the third quarter, forecasters are expecting very large increases in GDP. And so you see that with 29% annualized growth being the consensus forecast. That doesn't mean the economy is doing great, but we are coming from a low base. So that's a very large number there. And then as we get into the fourth quarter, expectations are we'll get more normal growth rates, so to speak. The other thing I want to draw your attention to is that there's considerable uncertainty around the forecast. So if you look at the table, the quarter-on-quarter growth, there's wide variation between the most optimistic forecast and the most pessimistic forecast and the consensus there. So that's something to keep in mind as we think about forecasts. And then a third thing to keep in mind is when we look at the year-over-year total year figures for 2020 and 2021, forecasts for 2020 have generally been revised up over the course of the pandemic. Earlier in the pandemic, say in June, forecasts were for the economy to contract 6%. Over time, various parts of the economy rebounded more quickly than expected. And so forecasters have come to believe that the economy will contract at around 4% this year. So in a sense, 2020 is not shaping up to be as bad as people feared it would be, although it's still not that great. Now, if this consensus is correct, it'll be around the end of 2021 when we start to see GDP climb back to its pre-pandemic levels. So in other words, it'll be a year, according to the consensus forecast, it'll be a year and a half after the recession started when GDP recovers fully from the pandemic. And to put that into context, it took 3.5 years for GDP to recover after the Great Recession. As I mentioned earlier, there's considerable uncertainty around these forecasts. Chief among those, these forecasts depend on the path of the virus. There are a lot of assumptions about what a second wave or another uptick in cases might look like. Will there be additional measures, social distancing measures that would restrict business activity? Will consumers voluntarily reduce their activity? And then there's also uncertainty around additional fiscal stimulus, whether that's in the pipeline, or if this recovery is protracted, will we see more firms undergo bankruptcy and weaken the recovery even further? So the takeaway for you here is so far 2020 is not as bad as we thought it would be, but it is still pretty bad. And there's a wide band of uncertainty there, and it all really depends on how the virus moves. Now, when we look at the monthly indicators, we see that the economic recovery so far has been very uneven. We've seen some sectors fully rebound and fully recover, but there are other sectors that are still struggling significantly. One area where we see this remarkably strong rebound is in the housing sector. I have on this chart here existing home sales and new home sales at a seasonally adjusted annualized rate. Both new home sales and existing home sales are both recovered to their highest levels since 2006. Shortly after stay-at-home restrictions were lifted in the spring, housing ended up being one of the sectors that bounced back surprisingly quickly. Low mortgage rates are certainly playing a role in this rebound. According to Freddie Mac's survey, a weekly survey of lenders, the 30-year fixed mortgage rate was 2.8% last week. And that's the lowest mortgage rate in that survey's history, which goes back to the early 1970s. This historically low mortgage rate is creating a sense of urgency among buyers. And on top of that, the inventory of existing homes for sale are about as low as they've been since the 1980s. Home sales are less than 3 months, or housing inventories are less than 3 months of current sales, which is extremely tight. So between low mortgage rates and tight inventories, there is that sense of urgency that's driving the housing market. Consequently, home builder confidence is at record highs, according to home builder surveys, and we are seeing home building responding. Permits are pointing to further increases in starts for single-family homes, which bodes well for the sector in the near term. When we look at other parts of the economy, we see a remarkable bifurcation in recoveries. An example of that is in consumer spending. So I have here consumer spending broken down by durable goods, non-durable goods, so orange and blue lines, and services in the gray line there. All categories of consumer spending took a hit during the early part of the business closures, but in the recovery phase, what we saw is that consumers shifted their spending towards goods and away from services. In the last couple of months, spending on durable goods has been near record highs. So these are things such as appliances, autos. Appliances are clearly being driven by the strong activity in the housing sector. Autos have been driven by very low interest rates and favorable financing terms. Auto sales came in at 16.6 million units at a seasonally adjusted annualized rate in September. And if we take 17 million as a rough benchmark for a good sales figure, we're pretty much there. So the auto sector has a lot of momentum behind it. Besides autos and housing, in general, consumers have benefited from a variety of things. First of all, household finances were in much better shape going into the pandemic than they were going into the Great Recession. So for example, going into the Great Recession, the personal saving rate, the national level, was around 3%. going into this pandemic, the saving rate was around 7%. So households had a little more cushion going into this particular disruption, which is good for consumer spending. Also, we can't ignore the tremendous support that households have received from stimulus checks and also the enhanced unemployment benefits that both of those combined really help build cushion there for households. And you see this in savings figures. I mentioned going into the pandemic, the personal saving rate was 7%, around 7%. After these payments, household payments were being made, the personal saving rate shot up to nearly 26%. So consumers were partly spending their money, but also saving them, which is really good for building that buffer. So we have a lot of things working in our favor. Consumer spending is around 70%, 2/3 of GDP. So this is a key part of the economic recovery. Now, on the services side, spending has gradually increased. You can see that in the gray line there, but spending remains well below pre-pandemic levels. Part of this is restrictions that we have on businesses and gatherings, but part of it is also consumers voluntarily reducing their activity, and so we see that in restaurant reservations, air travel, things of that nature. So the takeaway here is with consumer spending, the biggest chunk of the US economy, it's really split. Interest rate sensitive parts such as autos and housing are really doing well, appliances, durable goods. High contact, intensive service sectors are still struggling there. And it also highlights that there's increased risk if we do not have another fiscal stimulus. That support that we've had in recent months could potentially peter out and weaken the recovery in the months ahead. Now, moving on to the manufacturing sector, we get a similar story here of what is a bifurcated recovery. Overall, so I have industrial production split by end market group. Overall, industrial production has steadily increased since May. Industrial production has recovered about a little more than half of its March and April declines. On a year-over-year basis, production is down 7% in September. So that's versus from a year ago. When you break it down by end market group, you see there's wide variation in performances. Consumer-related production, you see at the very top there, durable consumer goods, non-durable consumer goods have shown resilience. On the other end, business equipment and energy-related production are still deeply in negative territory. From our contacts in the district, the firms that we speak with, we hear that firms in general, manufacturing firms, expect to be below pre-pandemic levels of activity going into 2021 and even a little beyond that. Many firms have at least paused, if not actually reduced their capital expenditures because they have excess capacity and they're trying to preserve cash because of the uncertain outlook. For now, there are some tentative signs that the recovery in manufacturing will be modest. Regional Federal Reserve surveys, the ISM manufacturing survey, they're showing some modest increases in new orders, which bodes well for manufacturing production in the near term. There is some potential upside from inventory restocking if we have a good holiday shopping season. Retailers, producers may want to replenish their stock, so there's some upside potential there. But as I mentioned, firms are still below capacity, and so the overall activity in manufacturing is quite subdued. And again, as with consumer spending, you see that variation across sectors, across end user markets. Moving on to the labor market. The labor market is slowly climbing out of the hole. The official unemployment rate fell for a fifth month in September, down to 7.9%. And that's down from a peak of nearly 15% in April. Despite this improvement, there are a few downsides in the jobs reports that we're getting. One troubling sign is that, and I don't have it included on the chart here, although the overall number of layoffs has trended down during this in recent months, the share of the layoffs that are happening that are permanent has actually crept up since May. And in the September report, 4 million respondents to the household survey mentioned that they had lost their jobs permanently. So this is not a good sign. This highlights the risk that as the pandemic drags on, what were intended to be furloughs and temporary layoffs will eventually become permanent as firms adjust to low levels of sales. So an increase in permanent layoffs is one troubling sign in the labor market. Another troubling sign is that you'll see on this chart here, labor force participation is still well below pre-pandemic levels. And you see that on the orange line there. There are a lot of people that have dropped out of the labor force since February. And of those that dropped out, 60% of those are women. So women are bearing the brunt of this disruption here. We hear that access to childcare and even uncertainty around schools. Will they go totally virtual, hybrid, back in person? All of that uncertainty has given job seekers pause to reconsider their engagement in the labor force. And so we do see that disproportionate impact on women versus men. And that's not a good sign there. Other reasons for why the labor force participation is still quite weak. There's concern that workers are concerned of contracting the virus. That may also be playing a role in keeping people out. And then we do also hear from some employers, not a majority, but from some employers that they believe that the extra unemployment benefits may have given job seekers a financial disincentive there. So there are a variety of reasons that led to this, but this is something that bears watching. A final point I'll make on this chart, going back to the theme of uneven recovery, we've also seen the jobs reports that it's clear that the adverse impact of the disruption from the pandemic have not been evenly distributed. We see unemployment rates for minorities and people with less than a college degree have increased more dramatically than other parts of our community. So for example, for those with a college degree, the unemployment rate increased by 3 percentage points. For those with less than a college degree, it increased by more than 5 percentage points. So that's a big gap there. By race, for Blacks, Asians, Hispanics, the unemployment rate is 6 percentage points higher than it was before the pandemic. For whites, it's 4 percentage points higher. And so we see that disparity there too. Another aspect of the job market that we see is that the pace of job gains that we've seen has slowed over the course of the summer. So I have on this chart here, two charts rather, the level of payroll employment on the right side and the change in month-to-month change in payroll employment on the left side. So you get the growth and the level there. So between February and April, the economy lost about 22 million jobs. That's roughly how much we added over the 10 years prior to that, the 10-year expansion. Since April, we've recovered about half of those jobs, half of that amount. But as you see on the left-hand side, the increments have narrowed since June. In June, the economy added 4.8 million jobs. That was a fairly robust number. It's diminished since then. By September, the economy added 700,000 jobs. So the growth rate has clearly slowed. If this rate of job growth, if job growth continues at the same pace, then we're looking at early 2022 until we're back to pre-pandemic employment levels. Early 2022 at the current pace. That may be too optimistic. We could see a further slowing of job gains. Our business contacts, when we survey them and interview them in the district, say that they're expecting to add workers very slowly, primarily because demand. They expect demand to grow very slowly for them, and to some extent, they become more efficient and may not need as many workers as they did prior to the pandemic. So the takeaway from all of this labor market information for you is the labor market is moving in the right direction. It is healing, but there is a long ways to go. We're still very much deeply in the hole, and we still have a long ways to go. Moving on to inflation. Consumer price inflation, which I have on this chart here, has ticked up. Oh, hey, Joe. Yes, go ahead.
I got a question. I was trying to wait till you transition. So the question comes from Mark Langford, and it said, did PPP play a significant role in keeping unemployment from being even worse? Will we need another round of CARES funding?
Yeah, that's a great question. So the PPP did prevent a significant increases in unemployment. So yes, the unemployment rate would have been higher had it not been for the PPP. There was a study, I cannot recall the exact number, but there had been some reviews of how many jobs did it save. And it did save a significant amount. I can't quote the number for you there, but the takeaway is it did. The second part of your question is, will we need another round? From what we hear in our contacts, the answer is most likely yes, for a couple of reasons. When we look at it from the household side of things, I touched on this earlier, but that fiscal support did provide significant cushion for household spending and household financial security. So some support there will go a long way to ensuring that there is continued momentum in that big chunk of the of GDP, which is consumer spending, and that affects businesses down the road too. On the business side, it appears that we do need some more support, namely for some of the smaller firms. They may need access to, they may need additional help with working capital to keep them going. They may need some more flexibility. not just for retaining workers, but also navigating the low demand environment. So, to go back to your point, yes, it's likely that another round of support is necessary to keep to ensure that the recovery continues.
Excellent.
And I
One more-
see another. Oh yeah, go ahead.
Oh, can you see it?
Yeah, will pent-up demand, the increased savings level lead to inflation as we come out of the pandemic? That's a great question. The answer is I don't believe it will. I'm not concerned about inflation picking up significantly. The main reason for that is a lot of the pent-up demand appears to have been exhausted as we reopened the economy or parts of the economy. So anything that was pent up then probably would have been expended by now. The other reason is, we still have a lot of slack in the labor market. Unemployment is still quite high. In a high unemployment environment, it makes it difficult for firms to raise prices. And so that, the weak level of aggregate demand means that price pressures are going to remain muted. So I'm not too concerned about inflation being really a big concern there. And that was actually the point that I was going to make here too. One thing that I'll point you to is the red line here is, so let me back up. We target 2% inflation. We don't use the consumer price index, which is what I show here. We use the personal consumption expenditures index, but they tell you similar stories here. What we see in the red line here, the median CPI, this is an alternative measure. And it basically, we line up all of the price changes by category and we just take the midpoint. And that midpoint is the median CPI. And that's a good way to track if there's any sustained shift in pricing over time. It's pretty stable over time, so it's a good indicator there. And so what we see in the median CPI is that it's trended down over time. And that tells us that, if anything, underlying price pressures are still quite weak. And also energy prices remain stable. And so overall inflation pressures are not a big concern. We have a question here. Would Q1 2021 be a good time to launch a new business venture? Well, I'm probably the wrong person to ask because I'm not an entrepreneur. But I will tell you this. I've been quite surprised to see how many businesses have started up. I speak with a variety of chambers, a variety of economic development organizations, various parts of our district, and surprisingly, there is entrepreneurial activity going on. So I'm not the right person to ask when to launch a business venture, but I can tell you there's a lot more going on than you would realize at this point. Do I feel a targeted or general support program will be more effective? Checks to all versus to specific sectors. So, the answer to this, I'll just give you my personal opinion. Let me preface that and just be clear that this is not, this is not an official position. This is just my personal take on it. It's really a trade-off here. Earlier in the pandemic, the priority really was we need to act fast. And in order to act fast, you need to have broad action. Targeted measures take time. They take deliberation. You have to be really intentional about it. And so having a broad sweep earlier on, I think that made sense. now that we're going into an extended, and now that we're further along into the pandemic and the recovery, and it looks like it'll be a multi-year recovery, yeah, targeted support makes sense, but that takes effort, it takes deliberation, it takes time. So those are trade-offs there that we have to make. But I agree with your sentiment personally that that would be a good way to go. Are there any more questions? These are all really good questions. So I'll move on to talk a little bit about the Federal Reserve's actions. I'm going to go back in time to March, actually, just to give you an overview of the aggressive action that we took early on. So some of this is not new news, but it's important to put it into bigger into context here. So early in March, very quickly, as it became apparent that the pandemic was going to cause an economic disruption, one of the first things the Fed did is that the Federal Open Market Committee quickly reduced the Fed funds rate by 1.5 percentage points down to a range of 0 to 0.25%. And it also gave forward guidance, meaning it gave language to suggest that it was going to maintain rates at that level until it's clear the economy has weathered the events. Then to ease financial conditions, the Fed stepped up its asset purchases. It had been limited to treasuries and $700 billion of treasuries. That cap was increased. It's open-ended now. It includes more assets. To stabilize financial markets, the Fed stepped up its repurchase agreements. It offered additional dollar liquidity to foreign central banks. Then the Fed encouraged banks to lend by asking them to work with their customers to modify loan terms and to use capital buffers to extend credit, with the idea that there won't be adverse regulatory consequences down the road. And then it also invoked emergency lending authority to expand or create a total of 9 facilities that potentially could provide more than $2 trillion in support. And I say potentially because it depends on how much of those facilities are used. You may have heard of the Main Street Lending Program. That's a new program that was created that falls into this bucket. It was targeted for firms that were too big to qualify for small business loans, but they don't have as easy of a time accessing capital as, say, the larger firms do. So it was targeted towards the firms in the middle. So those were all things that happened very quickly early on in the pandemic. Since then, since those early days, the Federal Open Market Committee, has held the Fed funds rate steady at that range of 0 to 0.25%. In the most recent committee meeting, in its statement, the FOMC reiterated that it expected to maintain this level of interest rate of the Fed funds rate until both inflation and employment were consistent with the mandated policy goals. So that would be maximum employment and 2% inflation over time. So then the question is, well, then when does the committee expect to raise rates again? So in the September meeting, they also released its updated projections. This is a messy chart, but I'll explain it. This is what we call what's known as the dot plot. It's part of the summary of economic projections. Each dot on the chart is a member of the Federal Open Market Committee, their forecast for the Fed funds rate in 2020, 2021, so on and so forth. And so what these updated projections show us is that for the most part, committee members expect that the Fed funds rate will remain unchanged essentially through 2023. None of them expect any increases in 21. One expects an increase in 22, and in 2023, there's a few that expect to see an increase. So essentially, no change for the next couple of years there. Also, over the summer, there was a slight. You may have heard about it. The the FOMC announced that it changed its monetary policy strategy. It now does what's called average inflation. It targets average inflation over the long run, a longer term. So rather than just trying to hit 2% at a point in time, they aim to get 2% over a longer period of time. And that will allow the committee to allow inflation to be a little higher than 2% so that it averages over time there. And part of the reason for that is inflation has been really low for an extended time, even when the unemployment rate was below 4%, inflation was not that high. So going back to the question earlier about pent-up demand leading to faster inflation, we haven't seen that yet. And so the Fed has changed its its strategy to achieving its inflation mandate. So bringing it all together now, some of the major themes to keep in mind when we look at the economic data. First of all, the economic recovery is highly uneven. And one way to see that is interest rate sensitive sectors such as housing and autos. They've seen the sharpest rebounds, while higher contact services continue to struggle. You can see this bifurcation when you look at demographic breakdowns for the job market. You can see this within industries, manufacturers that are servicing energy and capital investment. They're weaker versus those that are serving durable consumer goods. The bifurcation is throughout many areas of the economy. The second point to take away is that the labor market continues to improve, but the pace of that recovery has slowed, and there's still a lot of weaknesses that we need to address over time. And then finally, inflation pressures remain low. Monetary policy is highly accommodative right now, and it's likely to be accommodative for an extended time. That concludes the formal part of the presentation. Are there any more questions about anything we've talked about or anything we haven't talked about?
I don't see any rolling in yet, but I'm sure there will be. I do have a question for you. Is there a reason why I feel like the stock market hasn't responded in kind to the current economic condition?
Yeah, that's a good point. And actually, that was going to be on my list of examples of bifurcation, right? Main Street versus Wall Street. You see that split. With the stock market, a big part of it was, again, in my view, a big part of it had to do with expectations. It appeared that stock investors were pinning their hopes on a vaccine coming out. The stock market is more forward-looking, and so it reflected the expectations that the economy will get back to normal, so to speak, relatively quickly. And so stocks did well relative to other sectors of the economy. That's my explanation for why there was that divergence there.
Thank you.
And-
At this point, I don't see any other questions. Oh, wait a
Yeah.
minute.
I'll add some more, let me add a few more things to that too. The other thing to keep in mind is the stock market is not the US economy. And it's easy to get those two confused because the stock market represents the largest firms. And in many cases, it's weighted a certain way where sectors that are doing relatively well are doing, play a big role in those indexes. But we do see a lot of weakness in smaller firms, companies that may not be listed on the stock exchange. And so the stock market does, I think, mask a lot of underlying weaknesses that just aren't showing up in those indexes. Oil, gas, and coal are on the line with the election. Agree? Question. Please comment. I don't have a comment on that, to be honest with you. As far as the election goes, it's not my place to say. So I, unfortunately, can't really add much to that point. What we are seeing now is, as far as market forces go, prices are very low in energy. The U.S. has moved away from coal over time. Natural gas is exceptionally cheap. And so there's been this long-term trend there. And the energy sector right now is fairly weak, in large part because overall demand for energy is weaker because economic activity is weaker. And then also prices are also fairly low. So that's all I have on that.
There's a few more questions that have come in.
Yeah. I'm not seeing any on my end, so just let me know when you get them.
Okay, so I have, there's actually three of them. First one is election uncertainty affecting lending? And if so, will lending be looser after November?
That's okay. That's a good question. So is election or the elections affecting lending, and will they change? Will they be looser after November? I don't see the election itself affecting lending. There's always uncertainty with elections. We go through this every 4 years. The way we see it impacting activity in the district, in the region, it gives some companies pause whenever there is uncertainty to make risks and make capital investments. So there may be some of that going on as far as firms making investments. So that's one aspect of it. As far as lending goes, one of the concerns for lenders is, the overall outlook is uncertain because, many firms had deferred payments. They've been on, received fiscal support. And so there's a question of what happens when those supports wane and eventually some firms have to start making rent payments when demand is still weak. So it's not so much the election as it is the concern about what happens to demand as these various support measures wane. And so I think banks are concerned, as are many sectors, people in many sectors, about that. And I don't see the lending being connected to the election so much as it is to economic conditions and some of the precautions that banks will take given the uncertainties around other elements of the market.
Excellent, thank you. We've got two more questions. The next question, I know this is premature, but how do we even begin to pay back all the stimulus money? Is this something we need to worry about, or are we just not worrying about it? And is it just our children's problems?
That's an excellent question. It goes back, um, fundamentally, it's about solvency at the national level. So the debt burden for the United States is a concern. It's been a concern for some time. Now, at some point, it needs to be addressed. It's not sustainable. So at some point, it does need to be addressed. The general feeling is that now is not the appropriate time to do that, because you still need to get through this pandemic and get the economy back on a sustainable path to growth. The time to do that is when you are actually growing. So when we're expanding, when the unemployment rate is low, that's the time to pay down debt. That's the time to be more austere if you have to be, to do it. Doing that in a situation like now will only deepen the hole and take long, and it'll make it, it'll take longer to get back to normal if that were the case. So you're correct, it needs to be addressed, but timing also matters. And we need to do that when we're on a sustainable recovery path, not when we're still in this fragile and shaky situation.
Excellent. Last question, unless any more come rolling in. Are there expectations for the economy to react differently depending upon election results?
We don't make those. We don't have those kinds of scenarios. We generally don't factor those types of scenarios in there. So the way we approach it, we look at economic fundamentals. Candidates have different policies that they're campaigning for. Those don't get baked into the expectations until they actually are implemented. They become law. So we're not doing those kinds of scenario analyses. Other forecasting shops are. So I can't help you there. We're looking at what data we have right now.
Excellent, thank you. At this time, there are no more questions. So thank you so much for doing this. The information was, as always, fantastic. And oh, wait a minute, someone snuck in. So
Political decisions dictate spending, so it's econ. Yes, when the decisions become law, then we'll know what impact it'll have. Until then, it's campaign.
got it. Oh, looks like we have another question in here. Nope, that was it. And just a couple of comments in here that are saying, a great presentation, which I agree with. Thank you again for doing this, and it's always good to see your face. And again, congratulations on recently being married.
Thank you. Thank you. I appreciate it. And thanks everyone for the great questions and for taking time out of your day. And thanks again, Joe, for inviting me.
All the best. Be safe.
Thank you. You too. Take care.
Thanks, everyone.